Good morning, everyone. My name is Nikita. I'm the founder of Solace, and for the past 3 years, our focus has been non-financial risks in DeFi. We used to position ourselves as a DeFi insurance protocol. So really, this talk will be more about our experience over the last 3 years, what we have seen, what we have done, what other people have done, and that basically where we're at right now. Because we are relaunching the protocol with very different product from what you see in DeFi insurance. So first thing, I want to basically close off the things I will not talk about it today, other financial risks. I'm sure if you're in DeFi or leveraged any of the products, you're probably familiar with these things like market, liquidity risks, credit risk. But then the focus today is non-financial risks. So the term isn't really used in DeFi that much. It's more reserved for the traditional finance. However, there are still very similar categories in DeFi today. Like with the systemic risks, basically, if the chain stops, you lose the money. Or maybe you cannot cover off the lending position and the prices slides. Then there are operational risks. Those include basically hacks, exploits, and anything associated with the operation of the protocol. So we build DeFi apps and they break. And of course, there are regulatory risk. We all know the headlines of people, getting charged and the projects being shut down because of the compliance or centralization and stuff like that. So this chart is basically just to say that there are $1 billion being lost. We've probably seen some of the numbers or the charts that represent that image. And the point here is that although we've been through one bull run really pushing this product niche in the category, it hasn't really found the product market fit, and we still suffer from the same losses. So here's basically kind of like the map that I like to qualify different DeFi insurances or products that work with that type of operational risks. And one thing to note here is that the TVLs are super low. Really, it's just not a good way to make money. And generally, everyone is at a very heavy loss. If you're a single underwriter and you're lucky, your best chances you're just heavily underperform the market. So a year ago, we thought, okay, nothing really works. So I wanted to get back to the drawing board and think through kind of like the problems that we faced and if there's anything we can do about them. So capital efficiency is one, and it's just a fancy word for the fact that you cannot make money. It doesn't produce returns. And everyone originally thought of traditional insurance model because we know traditional insurance kind of works in finance and other niches for different products. And what everyone done, including ourselves, was taking the insurance model and then just trying to recreate that on chain. So that includes basically pooling the capital and then try to leverage that to underwrite different risks. And your hope is that all the premiums that you collected are going to cover off the losses over a longer extended period of time. That's really what insurance model is, and that's what everyone did. But another point with claims is more of like a user-focused problem because we really champion the idea of decentralization and try to make everything trustless so you don't have to rely on another party. However, all the claims involve human input, and there's really no good way to go around that. So you're kind of always at a mercy of either DAO voting or some experts or just a token voting. Neither of those really work in a trustless fashion, nor kind of immune from the manipulation. So oftentimes we've seen cases where people with a lot of tokens could just block or not pay out claims. So that kind of hinders the whole adoption, because theoretically, if you think that there are tons of different risks and you pool them well, you can produce returns, but that just doesn't work out that way. So this is a brief history of my past 3 years. In February 22, we launched a portfolio insurance. We thought, okay, maybe we can make an easy and nice product for the user where you just buy one policy and that covers your entire wallet across many different chains, and you kind of like just snooze on it. It basically works like a prepaid debit card or a SIM card, sort of a subscription idea. So you just like top up the balance and everything is insured. That allowed us to pool a lot of different risks. So at the top, diversification was we were insuring like over 100 protocols, and usually users are, use just one address and put all the liquidity in different DeFi protocols from that single address. And so that what allows you to like pool different risks, because you don't give them choice what to insure and what to not insure. It's either like all or nothing. So that kind of like helped us diversify the risk and make like this like very simple and easy product. It literally took 2 clicks to insure everything. But then, yeah, you still cannot make money with it. So we shut it down. Then we thought, okay, in every other industry, the projects and the companies that ship that product, they take responsibility for whatever they ship, right? That's not a standard in DeFi. You really just kind of like ship and things break and you fix and patch them and you continue on. We thought maybe we can try to push and introduce an insurance at the protocol level. So basically, I have a DeFi app and then I get insurance so my users can basically get some basic coverage. So Solace Native was focusing on that. Basically, we were setting like a minimum balance. So let's say like a $10,000. So every user is insured for like $10,000. But then still, like financially, there were a lot of like market and credit risk within that structure. So it didn't really take off. So we didn't ship it in production, even though it was like fully developed for like half a year. And then in November last year, so basically a year ago, we thought, okay, this whole like underwriting structure just doesn't work. There's a lot of risks, very little data to be able to rely on that. And so we thought, okay, let's avoid the losses, because as I said, we were like more lucky than the others, but everyone is in a deep loss. It's like tens of millions of dollars just being paid out without you actually generating any premiums. And another thing, we thought, okay, we know that audits now are a standard, right? And so if you want insurance to become a standard, perhaps we can slide those two together. And through all the data analytics, we discovered that audited protocol, if the code is audited and on-chain in that same state, then it's about like 3.5 times less risky. So it becomes, for us, a lot easier to insure, and so we can go much, much deeper into leverage. Just really fighting for the hope of being able at least go to zero and not make any losses. But then there's just a lot of operational headwinds, auditor businesses stuff. So for them, like focusing on developing new feature is a lot of work. But then more than that, there's little data. And so if you look at the smaller auditors, it's really tough to have any confidence into those probabilities that they produce and provide. So we start kind of like considering just generally, like what do we want from this product that hedges these operational risks and what we don't want. And really, it's kind of just playing off those two major flaws. Like we don't really want probabilistic confidence, because if you go into leverage, basically underwriting more dollars than you have, then it all comes down to the probability. And with probability, you have to rely on someone else. Like someone has to do the probabilistic analysis, and if you work with numbers, like there's so many different ways to go about it. There's no just fundamental probability. Like it's just all different modeling. And in DeFi, people don't like to rely on other people's numbers. So we thought, okay, maybe we can make a deterministic product. Like a good analogy would be lending. We know in DeFi there's over-collateralized lending, and when I first learned about it, I thought like, oh, that's what's the fucking point of it? Like I have the money, like why I'm borrowing less money than what I have? But then over the years, like of course it's pretty clear what value it provides. But in traditional lending, under collateralized is probabilistic, right? Someone like made a probability. With over collateralized lending, you always have determinism. Determinism basically means that for the same input, you have the same outcome. So it doesn't change kind of like along the route. And then, yeah, like with the claims, you don't want to have discretionary voting. So when something happens, and it's kind of like fundamental truth, you want to be 100% sure that you're going to get paid out. You don't want to, like, after the fact, rely and hope that people will actually judge in your favor or not. And so then when we look at the market structure and how you want to financially structure this product, as I said, you can go into like deep leverage, basically with $1, maybe like underwrite like 10, and hope that you're lucky and programs don't get hacked or have bugs. But then basically it just requires like a lot of data. In intelligence, we really have about like 2 to 3 years of data available. So even though you might be like super good at probabilities, all those probabilities have very little confidence levels. And then, yeah, just because of limited demand, it's hard to like diversify all that risk. So we thought, okay, again, along with the same lending idea where you have pure determinism, we thought, okay, can we actually maybe back everything one-to-one? Because then you don't need probability and you can make like a very deterministic outcome from whatever happens. And it doesn't matter, it doesn't require the human input for the product to perform the same way. But of course, like if you back everything one-to-one, the economics get technically even worse, right? So we started thinking like maybe we can come up with a product that actually has another use case. And if through that use case, which is popular and would be leveraged, you can bring in more liquidity and give room for those people on the other side to hedge some of those risks. So yeah, here's that analogy with like under collateralized versus over collateralized, and I just want to kind of like reinstate this idea of just determinism and how it's positioned on the opposite, contrary to the probabilistic approach. So the new idea that we are trying out, basically, we're gonna relaunch the protocol in about a month with virtually an exotic lending market where the collateral are not the market tokens, but DeFi products. So let's say you deploy capital to a yield aggregator, which gives you in return these Volt shares, or basically LSD also works for that. So any token that generates returns, it generates returns through a decentralized application, like some smart contract that give you the tokens. So if you can use that for lending and borrow against it, now you have the liquidity. And of course, you can degen more, and that's what I mean by that adjacent use case. We all know about leverage yield farming, and people use that. People take leverage for, let's say, like LSDs on some more traditional lending markets. But what actually allows you to do is sit liquid, and then if the hack happens, you just don't pay back the loan. With that like simple idea, you can navigate around all these like hacks and navigate around insurance. So let's say you have like staked ETH, you borrowed ETH against it, and then Lido goes down, right? For whatever reason, or like there's some catastrophic slashing, or just the whole app stops working. Then you just keep your ETH, and here's your insurance. So with that like simple idea, we're setting up just a 2 token pools that basically allow you to collateralize loans with DeFi products. So Ajna is one of the like this new lending markets that developed a true primitive in lending. Like you all know that the lending markets in DeFi rely on oracles. Ajna doesn't use oracles. It more leverages the idea of concentrated liquidity and that what allows them to navigate and work without the oracles, without any dependency externally, but that really unlocked the potential for these types of products because none of the traditional lending markets can add collateral of like just a product as collateral because there are a lot of risks to it. And then if you pull these tokens into traditional lending markets, then it blows up the whole risk. Because of course, like with those tokens, you can borrow the liquidity from the market tokens. And then if there's a hack, the entire market is screwed. So that's why you don't see any of those being added to, let's say, like Aave or Compound or even like smaller markets. So you really want to have an isolated two-token pool. So suppliers to that market, they only take risk of that token that is used for collateral. But yeah, like here is just a simple representation of what I explained. So you have just like one quote token, which is the supply and borrow token, and another token being the collateral. So suppliers to those markets, they underwrite that collateral. Just like on traditional lending markets, if you deposit any liquidity to that market, you are underwriting all the tokens being presented on that market. Many like less savvy users don't really like fully understand. So for example, like if you put USDT onto the Aave, you are underwriting Lido. And that's not very clear to most people. And so if you see any token that is derivative of some just pure governance or market token, you are underwriting. Virtually, you can think of yours like an insurance underwriter in that sense. So that's why we wanted to isolate and have just two token pools, but like not use oracles because of course like oracles like are another mess. And with the DeFi products as collateral, if you use an oracle, that's your human input, and you can think of it as like this discretionary idea. So if you want pure determinism, you have to remove those as well. So yeah, that's basically like the simple use case. We kind of like leveraged Pendle here. And let's say you start with like ETH and you go to Frax. We know Frax produce pretty good LSD returns. So you put them then to Pendle. You kind of like go through this loop and you stack up 4 different protocols to generate yield. But then if you can borrow against it, then you can offset all of that risk down. And if you have liquidity now in your wallet, there are kind of like 2 routes to go. Of course, you can degen more and like leverage yield or deploy to some other strategy, but you can also just sit liquid or deploy to like another safest strategy. So now it creates a very interesting relationship where the user actually becomes this like virtually underwriting capital manager. You know, in an insurance model, you have people with the money and they manage the money and the users just hedge the risk. Here, you're hedging the risk and also managing the underwriting capital. So the suppliers are more passive and that is done so you can basically drive more liquidity to those markets. And yeah, if there's an exploit, you just don't pay back the loan. Grazie. Thank you, Devlin.
Thank you very much.